I'd like to thank the organizers first for inviting us over to just give us some insight and share our views on what is the potential for the venture debt in the startup success. I'll probably start with an example, right? Yeah. So we had partnered with a VC-backed consumer-focused company. This was a company which had, of course, figured their product market fit and of course, had earned some amount of customer success there as well, right? VC money had come in, and that was to be used towards acquiring new customers to bump up their sales. Additionally, and because of this reason, since it was an early stage company, there was money that was being burnt. Roughly, they were burning about 2 to 3 crores every month, right? Additionally, there was capital that was required for their working capital needs, namely to stock up inventory, to pay the suppliers, and also a lot of the revenue was also being earned through the marketplace channel, right? And when you're doing it through the marketplace, it takes about 30 to 45 days to collect that money. So a lot of money had to be locked in working capital. Clearly, equity is not the most prudent thing to use given its the cost of capital is fairly high. And hence, it made absolute sense to deploy debt towards your working capital need. And that's what we did with respect to this particular company as well. And how did that work? It helped the company manage its working capital better. It helped them preserve equity, extend their runway, and also reach a certain revenue scale, which helped them reach a certain valuation before they hit the equity market the second time round, right? So that's the power of what debt can really do, even for the startup ecosystem. So what's the current landscape with respect to the debt market for startups? There is, of course, revenue-based financing, a lot of you would have heard of, right? And this is for companies where the debt is structured in such a way that the repayments are serviced from the revenue. So basically, a certain share of the revenue actually goes towards repaying your debt, right? But these come at a very high cost, and hence it makes sense for companies who are very early in their journey to take a revenue-based financing, right? Then, of course, there are these fintechs who are doing a lot of these invoice discounting products. This largely helps them resolve a lot of their short-term debt needs. Next are your NBFCs and banks. Of course, very early on, they did shy away from startup financing, namely largely on account of the fact that they don't quite fit into the traditional underwriting framework, right? Be it in terms of business vintage, be it in terms of founder background, because they're mostly first-generation entrepreneurs lately, these startups have, lack of profitability record, or even for the factor that there is no extra hard collateral that typically banks see, right? But having said that, lately, a lot of banks and larger NBFCs have warmed up to the idea of lending to startups, but it's largely through cash credit facilities and working capital debt. But again, this requires that a lot of your equity money is parked in fixed deposits, which sort of acts as a security for them. Again, not very prudent for the simple reason equity is expensive, and what you earn from the fixed deposit is not commensurate with that, right? So because of all these challenges, what we do see is that for the startup ecosystem and for the startup founders, venture debt has been the first port of call, right? And with respect to it's been the first port of call for most startup founders. And so what is really a venture debt product, and how is it really different from the other debt products that we have, right? Of course, there is a coupon-bearing loan on which the investor makes an interest every month, and the principal is serviced. So in that sense, it is very similar to any other debt product. But additionally, we do seek warrants. So assuming we are to do a 10 crore debt, we would seek like a 10% warrants, which is basically the right, but not an obligation to invest in the company's shares, right? And this gives the investor a certain amount of upside over and above what they earn from the debt product, right? So that's what a venture debt product is. So what are its benefits, right? Firstly, it's assuming instead of a venture debt, a startup goes for equity, right? If they are going for equity instead of venture debt, that is way more dilutive vis-a-vis venture debt, right? So in that sense, it makes a lot of sense to actually go for venture debt product. Also, vis-a-vis the other debt players, the advantage is that there's a lot of flexibility that is built in from a structure standpoint in terms of how the repayments should be structured, in terms of use cases as well. There is a lot of flexibility. It could be used for just runway extension. It could be used for acquisitions. It could be used towards your working capital needs. So in terms of end use, in terms of the flexibility in the structure, as well, and most importantly, vis-a-vis equity, it is definitely non-dilutive in nature, and that's the biggest advantage that venture debt brings to the table. I'll quickly give an overview about the venture debt market in India. Today, if you see, it has definitely gained momentum. There is a lot of education that's gone around this, and that's the reason over the last 5 years, in terms of the deployment, if you were to see in 2019, it was about 280 million. Last year, it was about 800 million. So there's been a significant growth in terms of venture debt appetite in India, right? In 2002, it did grow 50% over the last year. Now, typically, venture debt players are looking at startups which are not profitable, right? And they're still in the path to profitability. And there is a need for equity money to ensure that serviceability does happen after a certain point in time, right? There is no denial that it sort of moves in tandem with how the VC market sort of plays out, right? If you were to compare how the VD market played out in last year vis-a-vis VC deployment, there was some sort of, it was not in tandem. So if I were to give you some numbers here, in 2021, the VC deployment was about 36 billion, and last year it was 26 billion. It had actually dropped. On the contrary, if you were to look at the VD deployment, it had actually grown 50%. Clearly, given the market sentiments, given the fact that valuations have sort of been muted, and the VC deployment is also sort of very, is being extended at a very guarded pace. We did see a lot of startup founders actually substituting their capital in the form of venture debt. But having said that, there are no second thoughts on the fact that for VD to really grow at an exponential pace, there is requirement for VC deployment to also happen, because we are looking at companies which are strongly on the growth path and yet to turn really profitable. So they can't really service our debt just from internal accruals, right? So this year we do expect that it will be sort of muted in terms of how the VD market would be. But having said that, over the next 3-4 years, we expect this market to grow significantly to about 2 billion. So that's the potential that we see for the venture debt market. So how is Stride really placed? I'll probably just take a few minutes in terms of just introducing Stride to you. We had started about 3.5 years back. We are already in our third fund. The third fund is about 200 million in size, very similar to our second fund as well. We have deployed over 340 million over the last few years across all our funds. And this has been across 100 startups. And we are sector agnostic in nature. We've looked at companies in the consumer space. We've looked at companies in the B2B space. We've looked at companies in EV, agri. So we're sector agnostic. The idea is to partner with the best in the sector and scale it up as their business grows. Again, there are a lot of VD players in the market. So what sort of differentiates us is we do come in between equity rounds and not necessarily around an equity round. And that's because we do our own underwriting in terms of understanding the business moat, the industry outlook, what's the unit economics for the company. We deep dive in terms of understanding the business in and out, right? So we do take calls on the company in between equity rounds, and when a larger equity round happens, we have the sizable appetite to really grow up, take a larger exposure on the company. Additionally, outside of venture debt, we also offer a lot of these supply chain financing products. namely your vendor financing, your tie-up financing. When I say tie-up financing, let's just take the case of, say, Rapido. They do have a lot of drivers that they partner with, right? We had actually partnered with the drivers and provided them loans basis the transaction history that they have with Rapido. So the idea is to provide debt to the startups as well as the players in their ecosystem as well, right? So that's what we envision. We want to be the startup bank for all these startups. Clearly, I mean, I would finally end it with this point that I think we've just scratched the surface. The venture debt market in India is still fairly underpenetrated in terms of, if I were to give you a comparison versus US, the venture debt market in US is 15% of the VC market. In India, it's just about 3%, right? So we are fairly underpenetrated, and there's lots that we think we can do. And more importantly, we think at Stride we are well positioned because in terms of our product offerings, we do have venture debt and a whole bunch of other supply chain financing products, which enables debt to the entire startup ecosystem, and that's what we believe we want to do as well. Yeah. Thank you so much. Any questions? So, okay, I'll take up that question as well. Typically, when do we come in, right? If that's the question. We look at companies which have started generating some amount of revenue. So in terms of the ticket size that we operate in, it could be as small as 2 to 3 crores and could go up to about 100 odd crores. In terms of criteria, the company should have started some amount of revenue generation somewhere to the tune of about monthly, at least about 1 odd crores. And more importantly, should have raised at least 1 round of equity. Pre-series A is when we typically enter. Yeah. Does that answer your question?
Yeah, it does. It does. So I was actually wanting to know for a non-revenue generating startup.
Okay. So we come in, I mean, unlike equity, I mean, given we are a debt product, we offer a debt product, we come in only post-revenue generation and not pre-revenue generation. Yeah.
So in the Rapido example, do you have an NBFC license or do you partner with someone too?
So Stride Ventures is a venture debt fund. We also have an NBFC arm, which is called Stride One. And through this NBFC arm, we offer the supply chain financing products. So we have 2 different arms. Yeah.
Got it. Makes sense.
May I?
Yeah, sure.
So a couple of questions. The first one is, do you only look at logistic startups, or are you open for all the other or any domain startup?
We're sector agnostic.
Sector agnostic.
The intent is to partner with companies which are on a high growth trajectory. Should be tech enabled, that's one of our criteria as well. But in terms of sector, we're sector agnostic. Yeah. We've looked at fintechs, we've looked at EVs, we've looked at, of course, a lot of logistic companies as well, consumers, a whole bunch of them actually. Yeah.
Great. I am already green, revenue generated, profitable startup, but my numbers are not at what you mentioned, about 1 crore a month.
Sure.
Say I'm at about 10% of that on a monthly basis. Sure. I do that much in a year. Mm-hmm. So what's the process? How do we go about? Where can I go and find out more about it? And I can take it offline, of course.
Yeah, we could take it offline.
Sure. Thank you so much.